Hi, this is Jeff Camardo, the Wealth Doctor, with your crash course on creating tax-free Roth retirement income. Of course, we all know that Roth retirement accounts are tax-free, and converting money to Roths tax efficiently is really like creating wealth out of thin air, right? So if you can convert what would be taxable to tax-free at a relatively low bracket, and that is forever tax-free, and avoiding maybe big taxes, you keep more of it. That's like creating wealth out of thin air. Tax rates, in our view, are likely to go up for a lot of reasons. Watch my other classes and courses about this later in the 21st century. So sooner is probably better than later. Now, conversions before you claim Social Security can be really, really important because of the way the tax on Social Security and the cost for Medicare premiums, if you use that, and you probably will, are calculated. Adding additional fuel to the taxable income fire with Roth conversions probably is not the best thing. Some of you won't have a choice. You're already going to have pulled the trigger on Social Security, and there certainly are things that you can do. But if you have the option, I think it makes more sense to plan on doing the conversion, the steps before you claim Social Security. This is really, in my view, Roth conversions, which are really very complex. There's a lot of moving parts, are best executed by your sophisticated tax advisor and tax preparer. Again, there are a lot of moving parts because this is really what you want to do. Before I get into that, remember, you kind of reset the game every year. Why do I say that? Because there are so many things that change. The law keeps changing, your taxable income, the fixed taxable income, stuff you can't change, variable taxable income, things you maybe can change, like capital gains recognition and business losses, that kind of thing. You kind of reshuffle the deck every year. So you want to revisit and come up with a new strategy every year in order to maximize how much IRA or 401k or other retirement account income accounts you can convert to Roths in a tax favorable manner. Some years it may be a lot, some years it may be nothing at all. So each year, what I think my suggestion, using what I call my Rothalized, actually my trademark Rothalized process, is each year until all accounts are completely converted, these are the steps that I suggest that you follow. First, decide on what your acceptable bracket is, how much tax you're going to pay. You're probably going to need to pay some. If you have a lot of business or real estate losses, and you have a net loss for the year, maybe say it's a $100,000 loss, you can probably convert $120,000, $130,000, the way the tax math works, before you have any tax at all. But you may want to convert more than that, say if you can get up to a 15% bracket, 17% bracket. That's still pretty cheap. So figure out how much tax you're willing to pay. So decide your acceptable conversion tax bracket, one. Then estimate your baseline non-adjustable income. If you have W-2 income because you're employed, if you've got Social Security coming in, that's kind of, you haven't got much flexibility there. Pensions, annuities, what your baseline, unchangeable taxable income is going to be. Then estimate what other income might be deferrable. And again, if you own businesses and you can kind of adjust your W-2, or you have capital gains or unclaimed Social Security that you can wait on, and pensions that you can wait a couple of years, what other levers you have in the toolbox in order to minimize what your taxable income will be in the target year of conversion. Right now, estimate potential deductions like business losses, net operating loss carry forwards, Section 179, other depreciation, accelerated depreciation, using cost segmentation depreciation. If you're a business owner, real estate investor, that's really something that's often missed. Underestimated or unclaimed business expenses depreciation, do a deep screen for, gee whiz, what is it that would be legitimately deductible that my tax advisor or tax preparer or whatever hasn't considered? Can I take the home office deduction post-COVID? Could I have more percentage use in my business use of my vehicles than we thought? There's usually a lot of opportunity to find legitimate deductions, particularly if you're a business owner or real estate investor. So estimate what your prudential debits or deductions are against the income that we calculated and estimated at steps 2 and 3. Now do a pro forma on your taxes. Okay, I've got this much coming in. This is what my variable amount is. These are debits or deductions against that. And do a pro forma calculation, kind of run the numbers as if you're completing your tax return now, and see where it shakes out in terms of what your taxes would be and what tax bracket that you're in. And those of you that followed us in a long class on Roth conversion, or the big retirement class that I did, would then kind of look at number 2, include number 2 income, number 3 income on the screen, and maximize deductions from step number 4. And then you have the opportunity to estimate additional income that's recognizable to maximize or clear the target bracket. What did you just say there, Jeff? So I'm just saying that if you come in and say that you've got X amount of, I'm just making these numbers up for the sake of example, $50,000 of income that's in the 15% bracket, and the 15% bracket will go up to $75,000 before you go into the next higher bracket. I get 75 minus 50, $25,000 of additional income that I can recognize in that year to clear that bracket. Hopefully that makes sense. And again, I'm making the numbers up. They're smaller than they typically would be. But that's the kind of math you want to do. Okay, I've got this much wiggle room this year. If I minimize my income, maximize my deductions, where am I at now, and how much additional income can I recognize and still be at a pretty cheap rate. And then for risk-based assets, you want to convert those that have dropped in value to leverage your tax savings. If you got stock that you like that's gone down quite a bit, convert that now, and then it'll be at a lower, it'll be in a tax, almost the reappreciation will be in a tax-free environment and like that. And again, you repeat this in subsequent years in order to continue, the tax-efficient process of converting your taxable retirement accounts into tax-free Roth accounts year after year. And I know that was, this is kind of a longer form. That was about 7 minutes so far. And this is what I call a crash course. And gee whiz, that was an awful lot of information in a short period of time. But YouTube likes, this length for some of its stuff. But to get more detail on this critical and pretty complicated topic, remember to like it and all the other areas of wealth education I teach: estate planning, other tax, investments, asset protection planning, and so forth. Remember to like and subscribe for full access to all of my really short 1 minutes crash courses, typically 5 to 8 minutes, and extended wealth education classes. Thanks for watching. Until next time, this is Jeff Camarda, your Wealth Doctor.